Hello and welcome. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another quarterly update. And I've cherry-picked a few slides this quarter to share with you. Every quarter I meet with my team. We meet every week and we talk about the markets and review all of our client investment portfolios. And I ask them for feedback. I want to know what our clients are thinking. I want to know what information is going to be most appropriate. I want to know what information is going to be most helpful to keep them on their journeys, because investing is an emotional game as much as it is a technical game. So we sit and review investments on a quarterly basis. I've been doing this for a long time now, creeping up on 3 decades. Yikes. I've worked with some of the largest companies in the Fortune 500. I speak at conferences. I work as an adjunct professor. We've been published, and this content supports over 100 advisory firms nationwide, but it's really designed for the end user. It's designed for the retirement plan participant. It's designed for the person in retirement. It's designed to convey common sense investing truths and wisdom that can work to your benefit over time. So with that intro, let's jump into a little review of the markets and a few data points that caught my attention this quarter that I thought might be worth sharing with our audiences. First off, the markets were up 3% in the United States, flattish around the world. Bonds were up slightly. Emerging markets were up 5%. But good quarter. We continue to move based on the trend of the last few years. You can see this chart showing the market returns going back to 1996, and we're currently at all-time highs. So that has benefited all investors with any exposure to the markets. Fixed income has been lagging a little bit, and generally the most common of those investing truths is to have a diversified portfolio. You don't put all your eggs in one basket. So don't have 100% exposure to the stock markets. Mix in some bonds and other investments. And bonds now represent one of the more attractive opportunities that we've seen. And I'm going to share some data to put that into perspective for our investors. Every quarter, I share this chart that looks at how expensive or how cheap the markets are. You can see data here going back to 1994. At the upper end of this range, what we're tracking here is a price to earnings ratio. So price is what you pay, earnings is what you get. But you can see here that the average dating back over this 30-year time span is about 17 times earnings. We are now currently bumping up against what you might think of as the top end of that range at 20 times earnings. So markets look a little bit expensive. And one of the reasons that they look expensive is that earnings have been growing, and investors expect earnings to continue to grow. And this chart shows where those earnings have been coming from. We can break this down based on, well, let's see, on the left-hand chart, we have earnings growth to the S&P 500. And you can see that in 2024, earnings are up 11% so far. They're forecasted to go 14% in 25, 11% in 26. And if those expectations are met, well, then maybe the markets don't look quite that expensive. And I'm going to share some data with you. One of the reasons why investors are so optimistic at this point in the cycle is that we've seen some advancements in artificial intelligence. You've been living under a rock if you haven't heard about artificial intelligence and some of its uses. Well, it was one of the most common terms bandied about in the second quarter earnings reports of S&P 500 companies. Almost every large major corporation has a strategy for utilizing artificial intelligence and making their operations more productive. And as that comes about, we would expect to see that manifest in earnings growth to Fortune 500 companies, and that benefits investors at large. So investors are optimistic. Okay, let's look at it a little bit differently now, and I apologize for the eye test here. There's a lot of data on this chart, but I picked it because I wanted to focus in on a couple of columns here. The price to earnings ratio by sector. If we look at sector, we can see that the price to earnings ratio of energy, for example, is about 12 times. The 20-year average is about 13 times. So energy, as a particular sector of the market, is cheaper than where it has historically traded. And you can look across all industries, and with the lone exception of energy and real estate, all other sectors look fairly priced or maybe a little bit expensive. So again, just like we would ever so subtly and tactically shade our portfolios or overweight our portfolios towards the smaller stocks at this point in the cycle, we might similarly look towards energy and real estate to be some of the drivers of our portfolio going forward, as mean reversion continues to be one of the most powerful forces in finance. And what do I mean when I say mean reversion? Well, these averages, the markets will ebb and flow, but these averages have a tendency to pull stocks back in line with their historical norms over time. Okay, I mentioned alternative intelligence was driving much of this excitement in the market right now. 2024 is expected to see 183 billion invested in artificial intelligence. So investors obviously have reason to be excited about that. Okay, this next chart is one of the big defining themes of the current market, which is interest rates. Interest rates are now as high as we've seen them in several years, and I want to spend a little bit of time on this chart so that everybody understands it. What we're looking at here is, let me just focus on U.S. Treasuries. So if you'll bear with me here, U.S. Treasuries over the last 10 years have ranged from maybe 0.5% on the low end all the way up to about 5%. That's how they've fluctuated. If you look at the average, which is in purple here, the average over that 10-year period, and we're talking about a 10-year Treasury, has been 1.8%. Now look at the current interest rates in blue. Currently, those U.S. Treasuries are yielding 4.6%. So not quite 3 times what the historical 10-year average is. This represents a real opportunity for fixed income investors, and you can see that basic relationship hold across all different categories of debt outstanding, whether that be municipals or investment grade corporate bonds, mortgage-backed securities, asset-backed securities, or even international debt. So we're taking that into consideration as we design our portfolios for our end investors. Okay, and lastly, I've had some comments from investors about the right time to get into the markets. And whenever I hear that word time is now the right time to invest, I categorize it under market timing, and I cringe a little bit because as an academic, I know that market timing is detrimental to outcomes. Market timing is detrimental to investors' portfolios because when we market time, we're trying to second guess the trades of millions of investors globally putting capital to work. And to think that we're going to be smarter than the collective wisdom of Wall Street is generally a mistake. Most of the time, the expectations of the next 6 months, 12 months, 18 months in the future is priced in. Most of the time, you pay a fair price. And this chart shows some data that helps us answer the question, is now a good time to invest? When we put money to work at all-time highs, which is shown here in green, the subsequent average return over the next 3 months is 2.3%. The subsequent average return when we put money to work in the market on days when it's not an all-time high is 2.9%. So you can see here that if we identify only those periods of time when markets are at all-time highs, maybe they look a little bit expensive, and we have put money to work historically, well, we've been well rewarded. Over the subsequent 1-year period, you can see 13% return versus 11, 2-year, 28% versus 25, 3-year, 48 versus 40, 5-year, 79 versus 73. So this this chart I thought was worthy to share because it, hopefully alleviates some of investors' concerns about putting money to work in a quote unquote hot market. Trying to second guess the future is generally kind of a sucker's game, and this data would support that. The truism here that we're looking for is work with your financial planner. Make sure that you have a diversified portfolio so that yes, you can capitalize on these trends that have a tendency to drive markets higher, but at the same time, you can protect your risk and your downside by investing in those pockets of the market that look a little bit cheaper. Make sure that's nested inside of a well laid out financial plan. If you're early in your career, connect with your coach so that we can build you a quick 5-minute financial plan. And if you're later in your career or retired, then schedule an appointment with your financial planner so that you can look at some of those advanced components and add some peace of mind to know that your accounts are set up in a way that are going to fund your goals in a long-term manner. So thank you for your time. That's all I got for you this quarter. I'll see you again in another 3 months.